What if I told you there's a stock that has a dividend yield of almost 50% and is trading at a PE ratio less than 1? Well, there is one, and it's called ZIM Integrated Shipping. ZIM is an Israeli international cargo shipping company which was founded in 1945, which has evolved into a leading global container shipping company. ZIM operates in over 90 countries and has over 300 ports worldwide, which they offer a large range of services anywhere from dry cargo, reefer cargo, special cargo, and inland transport. And looking at the dividend, just last quarter they paid about 74 cents, in which the stock price is at about $15 right now, so that does not add up to about a 50% dividend yield, because each quarter, say they pay that exact amount, 74 cents, that means they would be paying about $3 a year, in which that would actually be about a 20% dividend yield. Even though that's still insanely high, it's still not right because of the inconsistency with these dividend payments. And we take a look at the quarter before that, they paid a whopping $3.17 per share, in which if they paid that every quarter, that would mean that this company would be paying about an 80% dividend yield. So this is very inconsistent dividend payments, and taking a look at some other times, they paid even $17, even though the stock price was up a bunch. In the past, we can see that they actually had a dividend yield of over 100% at one point. With that being said, the dividend yield would be worrying for me because of the inconsistency and also just the high dividend yield. But the good thing about this is the payout ratio is about 36.58%, which means that they're paying out about 36% of their net income in dividends. So normally we want to see this less than 50% to ensure the company saves some of their net income and not waste all their money on dividends. Although the company did say they're going to be paying about 30 to 50% of their net income in dividends, this still worries me just about the fluctuations in dividends, and if this company happens to start making no money, this company could go bankrupt right away. So that is a big worry. But I'm going to be taking a look at the financial health of this company using my 7-step stock analysis. Then at the end of the video, I'm going to be using my intrinsic value calculator to see if we should be buying the stock today. The first thing that I'm going to be looking at for ZIM is the PE ratios, and I want to see the trailing PE ratio profitable, which the trailing PE ratio is the price divided by the trailing 12 months earnings per share. And as we can see here, it is a profitable company and they're trading at a 0.8 PE ratio, which in comparison, the stock market trades at about a 25 PE ratio. So if you bought this company, you're technically paying 80 cents for $1 of earnings. So they are trading super low valued, and you'd be basically getting money right away back with your investment. And with the forward PE ratio, I want to see the forward PE ratio less than 30, in which the forward PE ratio looks at the price divided by the earnings per share, but the earnings per share is in the next year that analysts expect. So this shows us the future valuation of ZIM. And if we take a look at the forward PE ratio, we have nothing here because analysts probably aren't covering this company, so there is no forward PE ratio. But the trailing PE ratio, which could be a red flag or even a really good green flag, but we have to take a further look into this company in order to tell whether or not this trailing PE ratio is good. Now taking a look at the revenue growth rate for ZIM, I want to see a greater than 5% revenue growth rate in the company because I want to see the sales growing over time. And as we can see here, the sales are actually not really growing over the past 3 to 4 years. Nonetheless, though, over the past 5 years, they're technically grown at about a 21% average each year. So technically, they are growing over the past 5 years. But if we take a look here right now on this screen, we can see that they really aren't growing over the past few years. And this company is insanely cyclical, so they're going to have crazy moves in their revenue and earnings just because of the cyclicality of the industry they're in. And I would also be worried about the future because of trade wars happening. And there's going to be less shipping with this company. So even though this is a check mark, I would be worried about this growth rate. Now taking a look at the net income of ZIM, we can also see it's basically following the revenue growth rate, in which we had a huge spike in early 2022, and then since then we've seen big declines, in which the net income was actually negative for almost a year, and now they're back to positive. So this earnings growth rate also looks pretty bad out of ZIM, even though it's technically gone up in the past 5 years. ZIM is just a very inconsistent company, which makes sense because of the industry they're in. But I would be worried, especially because they were paying dividends during this time when they lost almost $3 billion. So this dividend really worries me about this company because say they lost this for a few years and they were trying to to pay this dividend off more and more, they're going to have to keep borrowing more debt in order to pay the dividend, and then after that it's just going to crumble over time if they can't make more and more money in the future. Now, taking at the shares outstanding, I want to see shares outstanding decreasing over time to give us investors a greater ownership in the company and to give us more earnings per share, which is why the earnings per share goes up over time when companies buy back shares. But as we can see here, they're diluting us investors and they're actually selling some shares. Even though it's not a lot of shares, they have sold a little bit of shares over time. So they are slightly diluting us shareholders, but it's not that big of a worry since it hasn't really moved much. Now, taking a look at the total debt to equity ratio, I want to see this less than 50%. If it's less than 50%, that means they have more than double the amount of equity when compared to their debt. So we want to see a greater amount of equity than debt. And as we can see here, they actually have more debt than equity. They have 148.29% total debt to equity ratio, meaning they have about 1.48 times more debt than their equity. So this looks pretty bad for ZIM. And taking a look at the total cash of $2.3 billion and total debt of $5.88 billion, the market cap on this company is only about $1.5 billion. So they have more debt than their market cap. Even though their free cash flow is at about $3 billion, I would be worried just because of the dividend yield. If they weren't paying this high of a dividend, I would actually think this company looks pretty decent. But this dividend yield, I think, is just a dividend yield trap for investors to buy this company. Now, taking a look at the analyst expectations for their earnings per share growth rate, I want to see over the next 5 years greater than 5% growth rate. As we can see here, they expect them to grow at about 26%. Although I think this is probably completely wrong, we don't really know much about the future because this company's in such a cyclical industry, it's hard to determine the future. And also, we don't know how many analysts are in this company. Since we saw that on Yahoo Finance, they didn't even have a forward PE ratio, meaning there's no analyst covering it on Yahoo Finance. This could be one analyst that just has such a crazy growth rate in the future. So me personally, I don't know. I don't think this is going to happen in the future at this growth rate, but you never know. Now, taking a look at my intrinsic value calculator, I'm going to be determining the price that I should be paying for this company and to see if we should be buying the stock today with this calculator. So the first thing I have to look at is the future annual growth rate. And personally, I think this company is actually going to slightly decrease over time. So on a conservative basis, I think they're going to decrease 5% each year. While this might be low, I need to be very conservative with these type of companies in which they're very cyclical. And like we saw with the revenue growth rate, we saw the company go from about $12 billion in revenue all the way down to about $5 billion. And with the net income of over $4 billion, in a few years they were negative $3 billion. So I'm very careful about this company and I'm trying to be super conservative. Now with the future profit margin, their profit margin has been anywhere from basically negative 30% all the way to 50%. So with that being said, I'm going to take an average between those two and say about 10% is fair. As of right now, they're at about a 20-25% profit margin, but I'm just going to be safe. Now for the future PE ratio. This company has so much uncertainty in the future, and that's probably why it's trading at such an insanely cheap valuation. But I think a fair future PE ratio could be about 5. I don't really know with this company what could be a good PE ratio. Even though it's trading at about a 1 PE ratio, back then they were trading at about a 3 PE ratio. They're just trading at a super low PE ratio. Now for the shares outstanding in the future. I think that in the future, their shares outstanding could increase at about 1% each year, which is fair, which they're diluting us investors very slowly over time, so that makes sense. With that being said, if we take a look at the future share price I have in the next 10 years for ZIM, I have a $20 future share price in the next 10 years. And I think if you bought this today with these assumptions, you can make only about a 3% return. And me personally, I am 100% staying away from this company. Even though I had insanely conservative growth rate numbers, I think it's just almost impossible to determine the growth rate in the future. It's much harder than determining companies such as Microsoft and like Costco because those companies have recurring revenue and subscription based and they're just easy to understand. This company is very hard to understand in the future and I would be staying away from this. And I think this is a dividend trap because I think they're only paying this dividend in order for investors to be in this company. If they didn't have this dividend, I don't think anybody would really want to invest in this company. So with That being said, I would not be buying this company at all. I would stay away. So thank you guys for watching this video on ZIM, and please hit the subscribe and like button. Comment down below what companies you want me to analyze next, and thank you.